Berkshire Hathaway Chairman and CEO Warren Buffett joining us.
स्टॉक मार्केट रिलेटेड इंटरव्यू वीडियो पाने के लिए मेरे चैनल को सब्सक्राइब करें और बेल आइकन को दबा दें।
When we were just out with Charlie Munger, he said he didn't think much of too many politicians, but he did like what Mike Bloomberg did in the city of New York. What do you think about Bloomberg as a potential candidate, and what do you think about Howard Schultz potentially running as a third-party candidate?
Well, I won't answer you on most questions, but I'll answer you on political. I would, if Mike Bloomberg announced tomorrow that he was a candidate, I would say I'm for him, and I think he would be. I think he'd be a very good president. And I mean, he and I disagree on some things, but I think that he knows how to run things. I think that he's got the right goals for America. He understands people. He understands the market system, and he understands the problems of people that don't fit well into the market system. I would have no trouble being for him. Howard Schultz, he says he's going to run as an independent, and if he ran as an independent, I think he would take votes away from any Democrat, including Bloomberg, if he were running. So I think it would be a real mistake for him to run. And I think generally third-party candidates, they're going to hurt one side or the other, and they're more likely to hurt the side that they actually favor because they're closer to that view, and so they pull more people away that would otherwise, go to the second best with that view. So I hope no third-party candidate runs that pulls any significant amount of votes. I mean, there'll always be a couple of people that file, but I think third-party candidates can thwart actually the will of the people.
I just want to run through some of the holdings, some of the changes that were registered, and get your take on why. First up, Apple. You trimmed 3 million shares to 249.5 million shares of Apple, and that caught a lot of people by surprise. They were wondering if you were selling.
No. The one other fellow in the office, one of the two, had about 6 or 7 million shares. He had it before I did, and he works with a limited amount of money, 13 billion roughly. So if he wants to buy something, he needs to sell something. If I want to buy something, I've got cash around to do it. So he sold about 3 million shares, I believe, cut it in half roughly to buy something else. And I didn't. I've never sold a share.
So this was not even a conversation you had with him, I take it? This is either Todd or Ted. You're not going to say who.
It's his business. Yeah, I mean, they do not check with me. I sometimes learn at the end I do at the end of the month. I look and see how their portfolio compares to the month before and see what they've done.
This generated a lot of questions from viewers, and let's go to one, T14. Jedi Marcus wrote in, if you loved it, meaning Apple, undervalued at $200 plus and $1 trillion valuation, at $200 plus and $1 trillion valuation, why would you sell any this past quarter? You've answered it already. You didn't sell.
Yeah, and incidentally, I've never paid $200 for any stock in Apple anyway.
Would you start buying at 160 or something? Was that?
No, no, I think
our
average cost about 141 or something like that.
Okay. There was a question that also came in from Rick Safaraz. This is T90. He said, do you plan on adding to your Apple position throughout 2019? And I just want to also bring up a tweet from Jim Cramer. He tweeted back on February 5th, doesn't Apple trade like Berkshire is back buying? I spoke with Cramer about it, and he said, look, I don't know anything. It's just all of a sudden the stock's really picking up. It's almost as if. So are you interested at lower levels?
I'm always interested at lower levels in a number of stocks we own. There's some where we really can't go over 10%, and generally I don't like to go over 10% because it complicates life quite a bit. With banks, it actually throws us into the bank holding company ground. So there are stocks that I would buy that we own 9 and a fraction percent, and I actually may be selling a little bit because they're repurchasing their shares, and I don't want to drift over 10%. But Apple, I don't see myself selling. The lower it goes, the better I like it, obviously.
I mean, Apple is not one of those 10% stocks. Don't you own about 5% of the shares?
About 5%.
So is this a situation where you have been buying since it came so much lower at the end of December?
It's really not back to where it may have briefly, very briefly got there, but if it were cheaper, we'd be buying it. We aren't buying it here.
There was another question that came in. This is T91 from Umar Zubair, who said Apple decelerated share repurchases from around $20 billion in the third quarter to around $8 billion in the fourth quarter, just when the stock price went down by about 30%. In fact, Apple repurchased 0 shares in December of 2018 when the stock hit a 52-week low. What are your thoughts on Apple's repurchase deceleration?
Well, and Apple has said publicly that they've repeated it, that their goal is to reach what they call a cash neutral position, where their debt is roughly equal to the cash. I think that would take $130 billion or so to get there, but of course they could make some acquisitions. On the other hand, they're earning a lot more than their dividends, so that number goes up. Mentally, I say to myself, we're very likely, and a lot of things could change this with them, and the lower the price goes, the better it gets, but they should be at 4 billion shares probably in maybe 3 years, and so our 5% would become something over 6% at that point, and I like that prospect. And then we might buy some ourselves, who knows, it depends on the price. But they will buy a lot more stock if it's cheaper than if it's higher, and you know, it's just simple math. We're better off if in the next 3 years Apple is cheaper.
You loaded up on financials in the fourth quarter. You added to your stakes in J.P. Morgan, Bank of America, Bank of New York, PNC, and U.S. Bancorp. And 6 of your top 10 holdings, I believe, are banks at this point. Why so much emphasis on the financials?
They're very good investments at sensible prices, based on my thinking, and they're cheaper than other businesses that are also good businesses by some margin. And a couple of those we own 9.5% of, and I don't like to go to 9.9 because that means the next quarter maybe I have to sell something. So I try to leave myself a year to 2 years of repurchases. But Bank of America has been particularly aggressive on buying a stock. And Brian Moynihan has done such a good job running that company since he took over. I mean, he was the most underestimated bank executive in the country, and he is everything he said he would do. He's done it, and he's beat it, and he sets tougher targets all the time for himself, and he's been smart about repurchasing shares.
J.P. Morgan is a relatively new stake. You had $35 million in the third quarter, and that was a new stake. You raised it to $50 million, or 50.1 million shares, I should say, in the fourth quarter. Is that your purchase? Because for a long time you held it in your own portfolio. Why now?
I've still got a little bit, but that goes back years and years and years. Yeah.
So why J.P. Morgan now?
Well, the better question is why we were so dumb about not buying it earlier. and the answer, I was dumb not buying it earlier. But it's a very well managed bank, and banks are. You can find a bank like J.P. Morgan earns maybe 15%, maybe 17% even on net tangible equity. A business that earns 15 or 16 or 17% on net tangible equity, that's incredible in a world of 3% bonds. I mean, just imagine that you had a deposit account with J.P. Morgan, that they made a mistake and they gave you 15% on it and they couldn't redeem it. What would you sell that account for? You wouldn't sell it for 100 cents on the dollar. You wouldn't sell it for 200 cents on the dollar. You wouldn't even sell it for 300 cents on the dollar. You'd have an FDIC guaranteed instrument that would now be at 300 cents on the dollar. If it was 15% on equity, you'd be earning 5% on it, which is way better than treasuries. Now, if on top of that, your deposit allowed you to let your interest compound to some extent, now that instrument becomes even worth way more. Because if you have an instrument that could compound at 15% for 10 years and use the added capital, that's worth way more than 3 times tangible equity at current interest rates, way more. So, you know, a lot of things can happen that change that equation around, and the banks, like almost all other American business, got a big plus last year with the new tax bill. I mean, corporations benefited a lot, including Berkshire, including the banks. That can be taken away, too. But on the other hand, the FDIC now has gotten replied. There were special FDIC charges on the big banks. They ended here recently because the FDIC has $100 billion in it now. That money has all come from the banks. The U.S. government has not put any money in the FDIC. People think that that somehow the FDIC is financed by the government. It's guaranteed by the government. But the FDIC was started in, I think, January 1st, 1934. And I think one time it borrowed temporarily, but it doesn't have a dime of government money in it. That money, and now they've got $100 billion in there, and the banks are much better off because that fund takes care of the bank here and there that goes broke. Incidentally, last year was no bank in the United States, no FDIC bank went broke. That's the first time in a long time.
Let me slip in one more question before we take a break. Oracle, that was a stake that you suddenly popped up in the third quarter that Berkshire had $2.1 billion of Oracle shares at the end of the third quarter. It went to zero at the end of the fourth quarter, which it's really unusual to see a technology company creep into the Berkshire holdings like that. And it's even more unusual to see it flushed out so quickly. Was that you?
Yeah, and Larry Ellison's done a fantastic job with Oracle. I mean, I've followed it from the standpoint of reading about it, but I felt I didn't understand the business. Then after I started buying it, I felt I still don't understand the business. I actually changed my mind in terms of understanding it, not in terms of evaluating it. I mean, Oracle is a great business, but I don't think, particularly after my experience with IBM, I don't think I understand exactly where the cloud is going. I've been amazed at what Amazon has done there, and now Microsoft is doing as well. So I just don't know where I don't know where that game is going.
That leads us to F4, which is a question from a viewer named Mark Hall, who said, with IBM bouncing back, how do you feel about getting out?
I'm glad I got out. We got out at a lot higher prices than this.
And then
I'm not knocking what they're, but the whole market's come back. And the market's at a high. That doesn't mean I don't mean it's at a high and then it's going down subsequently. I mean that it's just high. It's higher than it's been on, for really ever. I mean, when we met here 10 years ago, the S&P was at 666, and within a day or two of when we got together, and people thought America was washed up, and they were afraid of America. And what's happened? A quadruple in 10 years. How many quadruples do you get in your life?
You're a company that has never really shopped around for deals like that. What do you think of companies that do get special deals from states?
Well, I've actually helped Nebraska a few times when the governor or somebody's asked me to call a company. And everybody does it. I mean, it's just, it is a competitive game on locations. But it can be a little irritating in a sense when you're already here and you're employing thousands of people and they want to give special incentives to somebody who, and which they haven't given you, and in some cases to be your competitor. I mean, Amazon's going to compete plenty in New York regardless, but I mean, Amazon's is going to affect negatively the business of many, many, many companies in every state, including New York. That is, as Jeff Bezos says, your gross margin is my opportunity.
Does that mean you think New York was right to turn down the deal, or to kind of second guess the deal that they had originally proposed?
Well, that's what happened is they both got to the altar, and then the dowry was changed in a sense. I don't know all the details, and you're in a tough position if you're a company negotiating with public officials, because the public officials really can't necessarily be the last say. Whereas at the company, if the CEO says that you got a deal, you got a deal. And on the public side, there's a city council that has to ratify a mayor or something of the sort. So it's unequal that way. Now, our experience in New York and Buffalo has been fantastic. I mean, Geico went there and we got 3,000 people, and the communities helped, and Governor Cuomo's helped. I mean, just generally, it's been very, very, very good for us. But I think if you're going to have a bad marriage, it's better to find out before they pronounce you man and wife than after. They're both hurt a little bit by the fact that it went there. I mean, it makes people think twice about doing a deal where the community may get upset about you for one way or another, or that the politicians can't deliver on it. And from Amazon's standpoint, I mean, it hurts them a little too. Not a great big way for either one, but it's no plus to have things fall apart. So you really, as much as possible, you want to have that sort of thing sealed before. But you need labor unions, you need political figures. I mean, a lot of things can tank it on the public side.
You know Jeff Bezos very well. In fact, you're working with him and with Jamie Dimon on this healthcare initiative between the three companies. Can you give us an update on where things stand right now?
Well, we've got a terrific fellow in Atul Gawande running it. It is a long-term problem. I mean, process. And when we get through, we have to not only have a better medical service. I think we've got a lot of great things about our medical system, but it is costing us now 18% of GDP, up from 5%. And it is a tapeworm. And if any other costs in America had gone from 5% to 18%, federal taxes have stayed quite constant around 18% for 40 or 50 years. Same time, medical's gone from 5 to 18. Now, the little double counting there because Medicare's in it. But so we've got to stop the cost situation. But what we're hoping to find is something that will not only do a better job for our employees, but have them feel better about it and stop the ascending rate. You know, every point you chew up of GDP comes from somebody else. I mean, they're only 100 cents in the dollar, but it's a very long term. I mean, and we'll get something done. The probabilities, you know, I mean, we're trying to change a $3.3 billion industry, $3.3 trillion industry. I'm sorry, that really for the people participating in, they feel pretty good about it. I mean, the people getting the 3.4 trillion. The hospitals aren't unhappy. The PBMs aren't unhappy. The drug I mean, they may complain a little, but the people that are getting the 3.4 trillion are not screaming change.
Right. What are your thoughts on Kraft Heinz following all the current news, and what is your biggest concern regarding Kraft Heinz' future?
Well, we have some very, very strong brands at Kraft Heinz, and as I pointed out earlier, the company earns about $6 billion pre-tax, but after depreciation, not after amortization, but after depreciation, earns $6 billion on $7 billion of tangible assets. It's a fabulous business. It's in terms of return on tangible assets. I mean, this is a great business. We're sitting here at the Berkshire Mart, but the return's much higher at Kraft. It's much higher than it is at J.P. Morgan. It's much. You go up and down the list. There's very few companies that are earning $6 billion on $7 billion of tangible assets. But we paid $100 billion more than the tangible assets in buying, and we overpaid in Kraft. I don't think we overpaid in Heinz, and we borrowed money that related to projections that have not been met. We earn a lot of money, but we were paying out a lot of money, so we had very little in the way of retained earnings to reduce debt. So our debt of $31 billion is higher than we projected originally to rating agencies and so on, and we need to bring it down, and it comes down very slowly. I mean, unless you sell properties. I mean, even if you cut the dividend from $250 to $160, that's $1.1 billion a year. But on $31 billion, you'll go the right direction. But there's real debt to be reduced.